In one of my earlier diagrams, I was showing how the classic diagram for negative externalities. But what I want to go on to now is just to take that a step further and show one of the possible solutions. Now, of course, we spoke about having an external cost. One of the things we want to do in economics is internalise these third-party or negative spillover effects. One of the ways you can do that, of course, is with taxation. And we'll have a look at that on the board now. So the aim with taxation is really trying to increase marginal private costs. Now this could well be on firms, so you're increasing their cost of production. Ultimately that will be passed on to consumers in the form of higher prices. But let's have a look at this now. So marginal private cost. If we add in a new line, we'll add it there, and we'll call it marginal private cost plus tax. Okay, so what we've shifted, of course, is the marginal private cost curve so that it's nearer the marginal social cost curve. We're trying to internalise the negative externality. However, in this particular case, as you can see, whilst we had quite a bit of welfare loss initially, now we still have welfare loss, but it's this much smaller area here, this much smaller triangle. So, whilst partially the negative externality is being internalised, it's not being fully done so. To fully internalise it, what we would have to have is that marginal private cost plus tax is equal to the marginal social cost. Now in that case, instead of having this line here, you would just have one line here. And this would mean that the tax completely internalise the negative externality. In reality, that's actually a very difficult thing to do, and that'd be a nice evaluation point that you could include in a potential essay.